Commodities don't get the respect they deserve. That's the opening line in Jim Rogers' book, Hot Commodities. This seemingly simple statement encapsulates a profound paradox. We eat, clothe ourselves, heat our homes, travel, build, all relying on raw materials. Yet in the investment world, most people fixate on stocks, bonds, or real estate, treating commodities as a foreign land. This book emerged from a personal experience and a journey of discovery. Rogers, an investor who co-founded the legendary quantum fund with George Soros, quickly realized that seemingly mundane things like cotton, sugar, oil, gold, and copper are the true lifeblood powering the entire global economy. Hot Commodities isn't just an investment guide. It's a mental map of how the world operates through the rhythm of supply and demand, through decades-long cycles of boom and bust. But the big question posed from the outset and echoed throughout the book is, why is a sector that determines the survival of economies and human life so consistently overlooked by investors? Is there a hidden opportunity here? Or is it precisely in this indifference that patient observers will find a new gold mine? This is the starting point for a journey with Jim Rogers, dismantling myths, common misconceptions, and discovering how the most ordinary things can generate extraordinary profits. Part 1. The next big thing is physical. A new bull cycle is unfolding, and it's not in stocks or bonds. It's in physical things, raw materials, resources, access. The very things every human on this planet needs to survive. Every time you step into a supermarket or a shopping mall, you are walking amidst the world of commodities. Wheat, corn, oil, natural gas, copper, gold, silver, cotton, rubber, wood, sugar, coffee, cocoa, rice. All moving in a global dance of supply and demand. Without futures markets to establish and regulate prices, the basic necessities of our lives would become scarce and prohibitively expensive. These markets keep the flow of commodities in rhythm. This means if you want to be a truly successful investor, you must understand commodities, even if you only invest in stocks or bonds. Commodities deserve a place in every truly diversified investment portfolio. I know that in many people's eyes, commodity trading is fraught with mythical dragons of risk and loss. Many investors proudly recite the PE ratios of every stock, the balance sheets of tech companies, and are well-versed in bonds or exchange rates, yet they know little or only superficially understand commodities. They often recount a story of an in-law who lost everything in soybeans. This lack of knowledge has robbed them of a rare opportunity. Ask yourself, can you consider yourself a smart investor if you ignore an entire asset class? Imagine a stock investor in the 1990s who completely overlooked Microsoft, Cisco, or eBay. Wouldn't that seem odd? Yet, the majority of current investors are doing precisely that with commodities. A truth to remember: cheap commodity prices were the foundation that helped companies explode with profits in the 1980s and 1990s. But when raw material prices began to rise again in the late 1990s, corporate profits gradually declined. Those who are astute understand that when stocks go down, commodities go up. This pattern has repeated for over a century. Commodities are by no means a niche market. On the contrary, the natural resources market is the largest non-financial market on the planet. Considering just the 35 regularly traded commodities in New York, Chicago, London, Paris, and Tokyo, the total annual production value is $2.2 trillion. The volume of money traded on commodity exchanges often exceeds the total stock transactions in the U.S. Yet, financial newspapers, television, and experts still focus solely on stocks. They proclaim that the next hot stock is always lurking around the corner of Wall Street, and millions of investors believe them, only to be crushed in the dot-com bubble of 2000. The smart ones withdrew from stocks, moved into commodities, and they were right. I believe we are in the midst of a long-term bull market cycle for commodities. 20th century history has recorded three major surges: 1906–1923, 1933–1953, and 1968–1982. On average, each cycle lasted over 17 years, and since 1999, a new cycle has begun. My mission is to explain why and how you can profit from it. Remember, there's no mystery. The principle of supply and demand is the heartbeat of every fluctuation. When warehouses are full, prices are cheap. When inventories are depleted and demand increases, prices are forced to climb. The 21st century is no exception, and this time, opportunity has returned to those who know to buy value when it's cheap compared to currently overpriced stocks, bonds with meager yields, a real estate market already in a bubble, and a dollar drowning in debt. Commodities are clearly a worthwhile place to entrust your money. Reality has proven that in just 8 years after I created the Rogers International Commodity Index, it surged 254%, while the S&P 500 only rose 32%. If you ever thought commodities weren't fun, remember sugar rising 45 times from 1966 to 1974. Oil increasing from $3 to $34 in 6 years. Gold and silver increasing over 20 times in a decade, and from 1998 to 2006, commodities significantly outperformed stocks and bonds. To me, that is the true joy of investing. A friend of mine once called his New York broker, wanting to shift a portion of his portfolio into commodities. The broker, with a serious tone, warned, "Do you know how risky commodities are?" And then recounted a story about a colleague who once had a large corner office but lost everything in commodities. Eventually, she confessed that she didn't even have a license to trade commodities because she never saw a reason to get one. This is a prevalent mindset. After the longest bull market in history, most investors and advisors can't fathom that a different era has begun. The truth is, most investors need a mental detox. They are so fixated on stocks and bonds that they fail to recognize historical periods when commodities were the only asterisk place to generate returns. Remember, in the early 1980s, stocks languished for over a decade. Everyone believed equities were dead, but it was precisely then that commodities soared. Sugar rose 1290% in 5 years. Corn was up 295%, oil increased 15-fold, gold and silver more than 20-fold. The cycle repeated itself until the late 1990s when commodity prices plummeted to their lowest levels since the Great Depression. Meanwhile, the world consumed insatiably. Asia bombed, the US splurged, Europe and Japan also grew strongly. Gas-guzzling SUVs filled the streets. Gigantic houses requiring steel, aluminum, wood, and energy sprang up, and then the colossal dragon of China began to awaken. I was in Shanghai in the late 1990s. I saw a young woman on a motorbike, with brightly dyed hair, makeup, holding a mobile phone. That image said it all. China was no longer the nation of Mao Zedong's Red Guards, but an emerging consumer society. This country of 1.3 billion people needed everything: steel, copper, oil, corn, sugar, soybeans, cotton, and they were importing at breakneck speed. In 2003, China consumed 1/3 of the global steel output, surpassing the US and Japan combined. They imported half of the world's copper, 3/5 of its iron ore, and 1/3 of its oil. They sucked up scrap metal from Europe. They fed their enormous population with vast quantities of corn and soybeans from as far as Brazil and Australia, and their newly affluent sweet tooth drove sugar imports soaring. It wasn't just China. South Korea, Japan, and India were also consuming more commodities than ever before. India's economy grew at over 8% annually, the second fastest in the world after China. Russia, despite being rich in resources, was mired in chaos, making long-term supply even more precarious. And while all this was happening, the US was engrossed in the tech bubble, failing to invest in new production capacity for raw materials. The consequence? Supply withered, demand exploded, inventories were empty, commodity infrastructure investment had been neglected for decades, prices could only go up. Let's look at each sector. Oil, no major discoveries in 35 years. All the giant fields are old. US production peaked in the 1970s. The North Sea has been declining since 1999. No one knows exactly how much oil OPEC truly has because they have an incentive to inflate their reserve figures. The world is increasingly dependent on unstable regions like Venezuela, Niger, and the Middle East. Natural gas, North America faces shortages. New drilling isn't keeping pace with demand. LNG infrastructure isn't ready, and the Termino project faces environmental opposition. Production can only contract. Metals, almost no new mines in 20 years. Copper, silver, aluminum, palladium, lead all are in short supply. Even smelters and refineries are closing due to high energy costs. Sugar, few are opening new plantations, yet sugar is becoming an energy source as Brazil converts over 60% of its production into ethanol and millions of cars run on gasohol. This means sugar exports plummet, driving prices up. This situation isn't just short-term, it's the inevitable consequence of decades of neglected investment in commodities. And when people panic because prices rise, I merely smile because I know we are running on fumes. Once again, history shows that when stocks go down, commodities go up. From 1906–1923, commodities rose while stocks stagnated. The 1970s saw commodities hot and stocks cold. Conversely, from 1980–1999, stocks soared, commodities sank, and now the curve is turning again. Even during economic recessions, commodity prices can still increase. The Great Depression of the 1930s or the global recession of the 1970s, both periods saw commodity prices surge. This is because basic needs for food, energy, and building materials never disappear, and if supply dwindles faster than demand, prices can only go up. New research by Gel also proves that commodities have a negative correlation with stocks and bonds and are the best hedge against inflation, something I and many practical investors have known for a long time. When inflation escalates, when money loses value, commodities are the refuge. There's no mystery here, only the law of supply and demand. And today, that balance is heavily tipped towards commodity owners. That's why I believe this bull cycle will last for more than another decade. Part 2. But I've heard countless buts whenever commodities are mentioned, sounding like a chorus of skepticism, fear, and outdated beliefs. People nod, subtly sneer, and utter familiar phrases as if they were undeniable truths. But these are merely psychological walls preventing them from seeing the opportunity right before their eyes. But my relatives lost everything in commodities. There's always someone who tells a story about a family member, acquaintance, or in-law who plunged into soybeans or wheat and ended up empty-handed. That story becomes vivid proof for people to shake their heads and declare, commodities are too dangerous. Yet, if you listen closely, you'll find those failures often stem from a lack of knowledge, a refusal to learn risk management, or the greed for quick riches. Commodities don't kill anyone. Blindness, carelessness, and gullibility are the true culprits. What about technology? This was the loudest, but after the 1990s, when the internet bubble intoxicated the world, people believed technology was everything. Microsoft, Cisco, Amazon, eBay would devour the future. I don't deny the power of technology, but please remember that even Silicon Valley cannot exist without oil, copper, steel, electricity, and food. Computer chips don't magically appear. They require rare metals, energy, and global commodity transportation. Technology can change lifestyles, but physical things are the foundation of every society. But isn't it just speculation and a weak dollar driving up prices? This is a common argument in financial newspapers. Commodity prices are only rising because of speculators and a devaluing dollar. But if it were just speculation, the phenomenon would have ended long ago. The truth is, supply has been depleted for decades, while demand from Asia, especially China and India, has surged. That's a fundamental imbalance, one that cannot be explained by a few speculators on Wall Street. Speculation can amplify short-term fluctuations, but the law of supply and demand is the sustainable engine driving prices higher. But my stockbroker says commodities are too risky. I recall the story of my friend calling his broker to inquire about commodities. The immediate reaction was a lecture on risk, followed by a tragic example. In the end, the broker admitted she had never even bothered to get a commodity trading license because she never saw any need for it. This is a common situation. Most people guiding investors only understand stocks and bonds, while commodities are completely off their radar. They assess the risk of something they've never truly understood. Taking such advice is like letting a blind person lead you through a desert. But prices have been rising for years. Haven't I missed out? This is perhaps the most common fear, the fear of being too late, the fear of missing the boat. But look back at history. Commodity cycles typically last 15–20 years. The current cycle began in the late 1990s, so even if you enter a few years late, you still have many years ahead to profit. Missing a few early stations doesn't mean you've missed the entire journey. On the contrary, many jump in too early, endure a few initial corrections, and then flee. And that's how they rob themselves of the biggest gains. Commodities are not a game of chance. They are not blind gambling. They are where the most basic economic laws are laid bare. Low supply, high demand means prices rise. High supply, low demand means prices fall. When you understand this, you'll see most of those buts vanish like morning mist in the sun. These buts repeat like an old tune. And I realize that behind every objection lies a deep-seated fear. Fear of loss, fear of change, fear of stepping out of familiar habits. Yet in the market, fear is often the curtain that conceals opportunity. Look back at technology. People were intoxicated by websites that never made a profit, by dreams of 36,000% returns. They forgot that not a single byte of data can be transmitted without electricity. No server can function without metals and energy. Technology can shape an era, but commodities are the flesh and blood that nourish it. No one can eat Amazon stock, just as no one can warm themselves with Cisco stock. Humans still need wheat for bread, oil to run machines, copper to conduct electricity, sugar to taste sweetness. Or the but about mere speculation and a weak dollar. I've heard very intelligent people repeatedly say that prices are inflated. But when you look at the real data, oil fields depleting, no major new discoveries for decades, empty copper stockpiles, agricultural products not keeping pace with demand, it's clear this is not a speculative illusion. Speculation can make prices dance in the short term, but the long-term trend is carved out by supply and demand. And this time, the balance is heavily skewed towards demand. I also haven't forgotten the but from brokers about risk on Wall Street. Most brokers are raised on stocks and bonds. They live off commissions from stock trading. Try asking them about crude oil or copper, they'll shake their heads. They might not have even read a commodity textbook. Their warning is no different than someone who has never been to sea advising you not to sail. The real risk lies in a lack of understanding, not in the nature of commodities. And the but about prices already rising, that I've missed it reminds me of the past. In the 1970s, sugar went from 1.4 cents to 66 cents. Oil jumped from $3 to $34 in 6 years. Gold shot from $35 to over $800. In the early years, quite a few thought they were too late. But those who patiently stayed, accepting a few corrections, multiplied their assets many times over. Commodity cycles are not measured in short months or years, but in decades. Missing the first 2-3 years doesn't mean you're out of the game. I'm telling you all this not to argue with every skeptic. I write for those who have eyes to see, because if you only hear the echoes of those buts, you will never step into the land of opportunity. You will remain in the old, safe zone where profits are meager and bubbles are waiting to burst. These buts are a mirror reflecting crowd psychology. The crowd always finds excuses to procrastinate, to avoid acting. But I've learned, through decades of watching markets change color, that when the crowd says impossible, that's usually the time to start thinking differently. And so, I let those buts resonate like background noise. I don't chase them away. They help me realize I'm heading in the right direction, a direction the crowd hasn't dared to step towards. Part 3, Stepping into Basic Commodities. I am often asked, can prices really go higher? It's a question that haunts anyone looking at a price chart that has climbed for years. People fear they'll be late to the party, buying at the peak only to get stuck. But when you filter out the news noise and ignore street chatter, the answer is surprisingly simple. It all boils down to supply, demand, and substitution. First, let's look at supply. Around the world, for decades, we've lived under the illusion that natural resources are always abundant. As a result, investment in new extraction has been neglected. Infrastructure is aging, and many once-rich mines are now depleted. There haven't been any major new oil discoveries in 35 years. Large copper, lead, and zinc mines are quietly declining. In agriculture, arable land is shrinking, water resources are scarce, and production isn't keeping pace with population growth. This is a picture of a world where supply contracts daily. At the same time, demand is swelling more than ever. Think of China, an economy growing at an unprecedented rate. Over 1 billion people demand not just food to eat, but cars to drive, refrigerators to use, and houses to build. India is following suit, with a booming middle class and rapidly increasing demand for energy and metals in South Korea, Japan, and even smaller economies. A higher standard of living always means higher consumption. A single car requires tons of steel, hundreds of pounds of aluminum, copper, rubber, glass, and thousands of gallons of oil to produce. As the world enters a phase of massive urbanization and industrialization, demand can only go up. People ask, are there any alternatives? This is the constant hope whenever commodity prices climb. Can renewable energy replace oil? Can synthetic fibers replace cotton? Can new technology replace traditional metals? I've examined all of them. And the answer is consistent. Alternatives exist, but they aren't powerful enough to replace on a global scale. Ethanol can supplement but cannot replace oil for several decades. Synthetic materials might reduce some demand for copper or cotton, but cannot eliminate them. New technologies often require more raw materials rather than making old demands disappear. Take oil, for example. When oil prices rise, the press often paints a picture of hydrogen, solar, and wind energy. But the infrastructure for a global transition requires decades and trillions of dollars. Meanwhile, the demand for energy is immediate and daily. So, the world must still rely on oil until new supplies emerge, something that is becoming increasingly difficult. I recall the old lesson from the 1970s. When oil prices rose, many thought nuclear power would take over, that solar energy would explode. Some countries invested in nuclear power plants, but then accidents, costs, and public opposition hampered progress. To this day, nuclear power accounts for only a small fraction of global energy consumption. Solar and wind energy have developed, but their scale remains tiny compared to the billions of barrels of oil consumed each year. Even in metals, the situation is similar. When copper prices rise, people try to use aluminum as a substitute in electrical wiring. But aluminum conducts electricity less efficiently, heats up more easily, and isn't as durable as copper. Technologies like fiber optics replace copper in telecommunications, but fiber optics themselves require silica and many other raw materials. Substitution often merely changes the structure of use rather than eradicating the original demand for agricultural products. We also see this clearly. When sugar prices rise, people switch to artificial sweeteners. But the colossal beverage market still consumes massive amounts of sugar. When corn prices increase, some products substitute with wheat or rice, but the demand for animal feed and ethanol still pulls corn away. In short, when faced with the question, can prices go higher? I reply, look at supply, demand, and substitution. And all three factors point in one direction. Prices will continue to climb. What misleads many are short-term corrections. Commodity prices don't move in a straight line. They dance, they twist, sometimes soaring, sometimes plummeting. The press will call it the end of a cycle. Brokers will warn of risk. But true investors understand that these are just breaths in a long journey. I want to emphasize that supply cannot expand immediately. When stock prices rise, a company can easily issue more shares and raise capital. When real estate prices rise, people can build more houses. But with commodities, the process is completely different. To open a new copper mine, you need 7 to 10 years for surveys, permits, and infrastructure construction. To extract offshore oil, it requires tens of billions of dollars in investment and years of preparation. To expand agricultural land, you face climate change, limited water resources, and soil degradation. This means that even when prices are high, supply cannot respond in a timely manner. And it is precisely this delay that causes prices to continue climbing. Look at global reserves. Current grain reserves are only enough for a few weeks of consumption. Strategic oil reserves in many countries are no longer abundant. Exchange inventories continuously report record lows. This means any shock, a failed harvest, a political conflict, a natural disaster, could cause prices to surge suddenly. Meanwhile, demand doesn't wait. Every day, millions more Chinese and Indians enter the middle class. They eat more meat, and producing meat requires 5-7 times more grain than producing grain directly for human consumption. They buy more cars, and each car is a mass of steel, aluminum, rubber, and copper. They use more electricity, meaning more coal, gas, and uranium are needed. This new lifestyle is an irreversible long-term driver. I've been asked many times if we are exaggerating the prospect of increasing demand. I respond, go to China. Walk through the cities where cranes sprout like forests, where newly opened highways connect provinces, where tens of millions leave their rural homes for urban areas each year. Go to India, where information technology is booming, where the middle class craves every Western convenience. That's not an illusion, that's a vivid reality. And it's also important to remember that alternatives often only create new demands. When oil prices are high, people produce ethanol from sugar and corn, but that, in turn, creates additional demand for sugar and corn, causing their prices to rise too. When copper prices are high, people turn to aluminum, but then aluminum demand explodes, driving up aluminum prices. This spiral repeats across many commodities. Partial substitution, but overall demand ends up being greater. If you ever thought prices were already too high, remember the past. In the early 1970s, oil jumped from $3 to $34, an increase of over 1,000%. Gold went from $35 to over $800, an increase of over 2,000%. Sugar increased 45 times in a few years. All far surpassed what people once thought were peaks. Those who believed it can't go higher were left behind. The lesson here is clear. Supply is constrained, demand is exploding, and substitution isn't enough to curb it. When these three factors converge, prices have only one direction to go: up. I'm not saying the path will be straight. There will be corrections. There will be price drops that make newspapers gleefully proclaim a bubble burst. But for me, those are just opportunities to strengthen my position. The key is to distinguish between a short-term correction and the end of a long-term cycle. Those who don't understand will be fearful and withdraw. Those who do understand will stay and reap the full reward. And it's here that commodity investing is no longer a game of emotions, but a steadfast adherence to the logic of supply and demand. It's simple, yet also brutal. The world needs more than it has, and until that gap closes, prices will continue to climb to new heights. Part 4. Entering the commodity market. Once you understand why commodities are the future, the natural next question is, how do you step into this world? For many, the concept of futures contracts sounds alien, complicated, even dangerous. But in reality, futures are one of the oldest financial instruments, born from very everyday needs. Farmers want to ensure their harvest will sell at a stable price, and merchants want to guarantee they can purchase raw materials at a consistent cost. Imagine a wheat farmer. He sows seeds in spring and harvests in autumn. During that time, wheat prices can fluctuate wildly. If prices drop, his entire year's labor could be worth nothing but straw. To protect himself, he signs a contract to sell his wheat in advance to a buyer at a predetermined price. That is the essence of futures, eliminating risk, transferring risk from the producer to the market. The contract buyer could be a bread company, a food manufacturer, or an investor. For them, paying a fixed price in advance is also a way to avoid future instability. Both parties are protected, but at the same time, this also opens up opportunities for others, those who dare to profit from risk. An investor can buy a contract if they believe prices will rise, or short sell if they believe prices will fall. They profit from price fluctuations, and this participation makes the market more liquid and efficient. The flexibility of the commodity market lies in the fact that you can go long, buying contracts with the expectation that prices will go up, or you can go short-selling contracts with the belief that prices will go down. This is vastly different from stocks, where mostly you can only buy and hope prices rise. The ability to trade in both directions makes commodities a place to test an investor's courage and intellect. However, I must pause and clarify. Stop. This is where many fall. The allure of quick money in commodities has made many lose their guard. Without discipline, without a risk management strategy, they turn themselves into gamblers. The commodity market can reward you handsomely, but it can also devour you overnight if you are careless. The important thing is not to ignore risk, but to learn how to control it. A stop loss isn't meant to prevent profits, but to save you from major shocks. When you step into commodity trading, you'll find it's a world of its own. The Chicago Board of Trade, the New York Mercantile Exchange, the London Metal Exchange, these exchanges operate almost around the clock, with millions of contracts bought and sold. There, you'll find not only individual investors but also energy corporations, airlines, international banks, and even governments. They come to hedge, to secure supply, and to manage their risks. The problem is that when the press talks about commodities, they often only report sensational news. Decoding commodity news is a skill you must learn. You need to know when a piece of news is truly important for the supply-demand balance and when it's just noise. For example, a harsh winter in the US might affect natural gas prices, but a hurricane in the Caribbean will immediately affect sugar and coffee prices. Not all news items carry the same weight. It all comes back to the numbers. Commodity prices can fluctuate due to emotions in the short term. But in the long term, numbers about supply, demand, production, inventories, exports, and imports are the guiding light. A commodity investor must be someone who reads and understands dry data tables, knows how to put them into historical context, and compare them with global trends. Only then can you truly enter this market with open eyes. Once you become familiar with the concept of futures, you'll notice an interesting phenomenon. The price of a futures contract is not always the same as the spot price. There are times when the market is in a state called contango, where the futures price is higher than the current price because storage, insurance, and transportation costs are factored in. And sometimes, it's the opposite, called backwardation, where the spot price is higher than the futures price, usually due to exceptionally strong immediate demand, making people willing to pay more to get the goods right away. Understanding these two concepts is key because they reveal the underlying dynamics of how supply and demand are operating. I remember the first time I observed the oil market go into backwardation. Companies were willing to buy spot oil at significantly higher prices than futures contracts. That wasn't financial magic. It was a clear alarm bell that the market was so thirsty for oil it couldn't wait. Conversely, when contango persists, it tells you that supply is abundant and storage costs make long-term contracts more expensive. Once you step in, you'll find that the commodity market has its own rhythm, far different from stocks. Here, real-world events, a storm, a drought, a political decision, an oil field incident, can change prices instantly. It's not earnings reports, not PE ratios, but weather and geopolitics. Therefore, what I always emphasize is, never underestimate the next step. Many hear stories of quick money and jump and head first, without preparation, often resulting in swift losses. Then they become one of those pessimistic, but voices I described earlier. The next step isn't to rush into the market with all your capital, but to learn how to observe, how to analyze, and how to be disciplined. The commodity market doesn't reward blind recklessness. It only rewards those who are patient, understand the laws of supply and demand, and accept that sometimes they will be wrong. Every futures contract is a commitment, and that commitment is only meaningful when you understand the entire picture. Global production, inventory levels, China's import demand, weather conditions in Brazil, political situations in the Middle East. These are pieces that cannot be ignored. It's also important to clarify that direct futures trading isn't suitable for everyone. For many, simply understanding and monitoring the market is enough to enhance their investment perspective. Because even if you only buy stocks, knowing how oil, copper, and grain prices fluctuate helps you predict companies' profits. How much pressure will an airline face when oil prices rise? How much will a food producer benefit when sugar prices fall? That's the connection between commodities and other asset classes. I've always stressed, to be a good investor, you must know about commodities, even if you don't trade them directly. Because commodities are the foundation of the real economy, and the real economy ultimately determines the value of everything else. The world of commodities may seem complex, but its core remains supply and demand. If you learn to read the numbers, observe reality, and maintain discipline, you'll find it's not a maze but a clear path. Futures markets are the tools for both protecting and seizing opportunities. And when you are ready for the next step, you will realize this is where the most fundamental principles of economics are revealed in their most vivid form. Part 5, Notes from the Wild East. I once heard an Asian friend tell me, if you want to understand the future of commodities, look to the East. And he was absolutely right, because what's happening there is the rise of red capitalism, a form of capitalism draped in red. China, after decades of isolation under Mao Zedong, opened up during Deng Xiaoping's era, and since then a peculiar model has emerged, an economy nominally socialist, yet operating under fierce market rules. We are witnessing the rise of a new dragon, and that dragon needs things asterisk physical things. A developing economy with 1.3 billion people needs things. It needs steel for skyscrapers, copper for wiring, oil to run cars, soybeans to feed livestock, sugar, coffee, and rice to nourish hundreds of millions of laborers leaving rural areas and flooding into cities. Never before in human history has an economy with over 1 billion people grown at this rate. Look at the numbers. In the early 2000s, China was consuming over 1/3 of global steel production, over half of the world's copper, and an ever-increasing share of oil imports. They buy from Brazil, from Australia, from Africa. They don't just buy raw materials, they buy mines, plantations, forests, and oil wells. China is not just a customer, they are becoming major shareholders in the world's resource economy. I've traveled through Shanghai and Beijing, seeing skyscrapers mushrooming after the rain. Each of these structures represents tens of thousands of tons of steel, cement, glass, and aluminum. I've seen highways connecting provinces, with millions of brand-new cars driving on them. Each car is a pile of materials: steel, copper, rubber, oil. Every sign of prosperity comes with an immense amount of commodities. But the story doesn't end with consumption. China is also posing a big question for the global financial order. Many scholars are beginning to ask about the next world currency. Could the yuan become a counterweight to the US dollar? Of course, it's too early to say. But if you observe their quiet steps accumulating gold, expanding trade in local currency, establishing bilateral agreements, it's clear China is preparing for a future where it's not just the world's factory, but also a financial center. Place China next to India, and you'll see an interesting comparative picture. Both are populous, both are rising, both need commodities. But China has advantages in speed, infrastructure, and concentrated political will. India, a boisterous democracy, progresses slower but has a strong technology and service sector foundation. Despite their differences, both are drawing colossal resources from all corners of the world. As a commodity investor, you don't need to judge who wins or loses. You just need to know that both will contribute to exploding demand. Of course, every dream has a flip side. The imperial ambitions and rapid growth of China also harbor risks: real estate bubbles, corruption, inequality, internal political conflicts, and even expansionist ambitions from the South China Sea to Africa, which could push the world into new tensions. Any stumble by China could shake markets. However, even in a bad scenario, there's a positive aspect to the negative. That is, even if China falters, basic needs for food, energy, and metals will persist. 1.3 billion people cannot stop eating, moving, or heating their homes. A downturn might cause prices to fluctuate in the short term, but in the long term, the reality of supply and demand remains. That's why I believe that even political or economic shocks cannot completely reverse the grand trend. When I look at China, I don't just see a growing economy. I see an insatiable hunger for physical things. And that hunger is the driving force propelling the entire world into a new era of commodities. I remember standing on a port in Shanghai, watching giant ships dock, carrying coal from Australia, oil from the Middle East, copper from Chile, soybeans from Brazil. China is no longer a small-scale buyer, they are the largest customer. And when they make decisions, the entire global market must adjust accordingly. China is also shrewd not just in buying goods, but in buying supply itself. They invest in oil fields in Africa, build railways in South America, acquire rubber plantations in Southeast Asia. This is not merely commerce. It's a long-term strategy to ensure that a colossal nation of over 1.3 billion people will not go hungry for raw materials. Of course, not everything is rosy. The dizzying pace of urbanization has created vast inequalities between rural and urban areas. Wealthy cities shine brightly while millions in the countryside remain poor. The drawback of a rapidly growing giant economy is the risk of political instability. If discontent spreads, if asset bubbles burst, if the banking system faces a crisis, the shock from China will not stop at its borders but will ripple across the world. But even in that situation, the positive aspect of the negative still exists. 1.3 billion people cannot return to living as they did during the Mao Zedong era. Living standards have risen. The demand for electricity, Cars, food, and housing has become an irreversible habit. So, even with a crisis, basic demand will continue. That means, in the long run, commodities will still be consumed, and prices will still rise when supply is constrained. Next to China, India offers another mirror image. India doesn't develop top-down like China, but in a chaotic, democratic manner, with thousands of voices and countless interwoven interests. This makes the pace slower, but also creates a different kind of stability. India's middle class is growing, and demand for commodities is also increasing. With over 1 billion people, India has the potential to become the second driving force after China, adding to the global thirst. I'm not predicting who will surpass whom. I only know one thing for certain. Both nations will fuel an explosion in commodity demand, and with tightening supply, that can only lead to one outcome: prices going up. So, when people ask me what will determine the commodity cycle in the next decade, I answer: look to the East. There, billions of people are changing how they live, and every small shift in their consumption habits creates global ripples. For me, that's not just an opportunity but an inevitability. China and India are rewriting the map of commodity demand, and the rest of the world, whether it wants to or not, must follow that rhythm. Part 6. Farewell to cheap oil. I've heard this question hundreds of times. Is today's oil crisis just a temporary fever, or is it a sign of a new era? The answer, for me, couldn't be clearer. Today's oil crisis is not fleeting. High oil prices are not solely due to a war in the Middle East or an OPEC decision. They reflect a fundamental truth: cheap oil has disappeared. Let's start with supply. For decades, we've been accustomed to thinking that oil is infinite, but the reality is that production in many places has peaked. The U.S., once the world's largest oil producer, reached its peak output in the early 1970s. Since then, despite technological improvements and deeper drilling, U.S. production has not returned to its old levels. The North Sea, the pride of Britain and Norway, peaked in 1999. Since then, production has steadily declined, and this situation isn't happening in just a few places. It's a global trend. The only pillar the world clings to is Saudi Arabia. In every discussion about oil, the question always returns: how much do they really have? The debate in Saudi Arabia has never ceased. Saudi Arabia claims vast reserves, enough to supply the world for decades. But those numbers are never independently verified, and their motive to inflate reserves is too clear. OPEC production quotas are based on declared reserves, meaning the more they report, the more they are allowed to export. This lack of transparency plunges the entire world into a guessing game about its lifeblood. Beyond Saudi Arabia, the world also looks to Russia, one of the largest oil exporters. But who dares to trust an economy dominated by corruption, aging Soviet-era infrastructure, and unpredictable political upheavals? Leaking pipelines, inefficient refineries, deteriorating distribution systems all make Russia's supply never absolutely reliable. Then there are other question marks. Venezuela, with large reserves but mired in political instability. Nigeria, rich in resources but plagued by internal conflict, corruption, and violence. Iran, always caught in a cycle of sanctions and international tensions. Every country on that list is like a fragile bridge. Any tremor could shake the global oil market. People often ask, if oil is so expensive, can we find alternatives? Nuclear, solar, wind, ethanol all are mentioned. But the reality is that they can play a supplementary role, but cannot replace oil in the next few decades. Remember, currently over 90% of global transportation relies on oil. Billions of cars, trucks, planes, and ships are all designed to run on gasoline or diesel. There is no alternative energy source that can immediately replace that massive scale. Nuclear power can generate electricity, but cannot fly a Boeing 747. Ethanol from corn or sugar can be blended into gasoline, but it requires vast tracts of cultivated land, directly competing with food production. Solar and wind energy, despite their promise, still only account for a tiny fraction of the global energy picture. The transition to any alternative source requires decades and trillions of dollars. Meanwhile, oil demand is immediate and daily, and this world still runs on oil from the car you drive, the house you live in, to the clothes you wear. All have oil somewhere in their production chain. When oil prices rise, it doesn't just affect gas stations. Oil prices and the global economy have a tight relationship. Transportation costs rise, production costs increase, food becomes more expensive, inflation spreads. Oil prices are not just a number, they are the heartbeat of the global economy. When oil was cheap, the whole world lived in an illusion. Transportation companies expanded, consumers bought bigger cars, countries spent more. But now that cheap oil is a thing of the past, we are forced to confront the truth. Farewell to cheap oil. And when you understand this clearly, you'll see why oil is not just one commodity among many, but the most important commodity, with the power to dominate everything else. Let's look back at history for greater clarity. The oil crisis of the 1970s stunned the world. Just one political shock: OPEC cutting production, Middle East war erupting, oil prices quadrupled, and the global economy plunged into recession. People lined up for gas, inflation soared, unemployment skyrocketed. That lesson should have been deeply ingrained. But as oil prices cooled in the 1980s and 1990s, the world reverted to old habits: consuming more, wasting more, investing less in new supply. This led us into the 21st century with increasingly depleted reserves and unprecedented demand. Large fields in Alaska, the North Sea, and Mexico are all declining. Even Saudi Arabia, though still considered the world's oil tap, cannot forever be the savior when a colossal economy like China explodes, importing millions of barrels of oil every day. The supply-demand balance is stretched to its extreme. Alternatives to oil: nuclear, solar, wind, ethanol all have their place, but are not enough to change the big picture. Nuclear faces fears about safety and waste. Solar and wind require storage technology that is still too expensive. Ethanol drives up corn and sugar prices, ultimately putting pressure on food supplies. This means every alternative solution carries other consequences. And while we debate, the world still consumes over 80 million barrels of oil every day. This leads to an inescapable conclusion: high oil prices are the new normal. It's not an anomaly, not a fleeting fever, but a new state of the global economy, and its effects ripple through every sector: transportation, manufacturing, agriculture, and even politics. When oil prices rise, grain transportation costs increase, bread prices rise, people get angry, governments scramble. Oil is not just energy, it is the catalyst for stability or chaos. I've been asked many times if we can return to the era of cheap oil. My answer is no. The days of $3 oil are just a memory. Even $20 oil is unlikely to return unless the global economy completely collapses. The new reality is that to extract new fields, we have to go further, drill deeper, spend more, production costs rise, environmental risks increase, and therefore, the floor price of oil must also be much higher. When you understand this, you'll see why oil is not just one of many commodities, but the commodity of commodities. Oil prices directly affect everything else, from fertilizer prices, transportation costs, food prices, to steel, aluminum, and copper prices. Oil is the link connecting the entire system, and therefore, when we say farewell to cheap oil, we are not just talking about gasoline prices, but about a structural change in the global economy. The only thing you can do as an investor is to accept that reality and prepare. Expensive oil means other commodities will also be expensive, and in such a world, those who hold commodities will not only survive but thrive. Part 7. Gold, Mystical Aura and Fundamental Value. No metal embodies both such mystique and such strong practical fundamentals as gold. For thousands of years, gold has captivated, driven humans to madness, inspired murder, conquest, and even the building of empires. And today, even as the financial world overflows with stocks, bonds, and derivatives, gold stands as an undying symbol of wealth and trust. Let's start from its history. The United States once held most of the world's gold, especially after World War II. As other nations, exhausted by the gold standard, the dollar was directly linked to gold, making the U.S. the global monetary center. But in 1971, Richard Nixon severed that link. The dollar was no longer convertible to gold, and from then on, gold ceased to be official currency. Yet, paradoxically, it became a refuge whenever people lost faith in paper money. Looking at supply, we see a unique picture. Unlike oil or copper, where large new deposits can be found, gold has seen almost no major discoveries for decades. Global mining output increases very slowly, while extraction costs are rising and ore quality is falling. Deeper drilling and processing more rock are needed to obtain less gold. This means new supply cannot keep pace with increasing demand. Meanwhile, demand never disappears. For millennia, humans have craved gold for jewelry, for storage, for worship. Central banks also cannot completely turn their backs on gold. When instability strikes, when inflation rises, when the dollar falters, they quietly buy. Additionally, modern industries, from electronics to medicine, also need gold. Demand comes from many sources, and all are persistent. Speaking of prices, we see tremendous volatility. From a fixed $35 an ounce, gold soared to over $800 in the late 1970s when inflation exploded and faith in paper money collapsed. After that, it fell, for a long time considered a dead metal, unprofitable, ignored by everyone. But then, whenever the world tottered, gold revived. Monetary crises, wars, recessions all cause gold to shine again. This is the parallel between its mystique and its fundamentals. The mystical side, gold is linked to mythology, aspiration, and the deep human psyche. The practical side, scarce supply, persistent demand, high costs, and its role as a safe haven. This combination makes gold one of a kind. Those who believe gold is merely a relic of the past, that the era of stocks has replaced it, are mistaken. History always proves that whenever faith in the financial system wavers, gold returns as the ultimate currency, independent of any nation, not infinitely printable, and not easily devalued. Gold is attractive not just because it's beautiful, but because it's a measure of trust. When people believe in paper money, gold is forgotten, its price slides, called a useless metal. But when trust falters, inflation rises, public debt swells, central banks print money excessively, then gold becomes the refuge, and this has repeated over centuries. Recall the 1970s. After the US severed the link between the dollar and gold, paper currency floated freely for the first time. The result was exploding inflation, soaring prices, and collapsing confidence. And in that context, gold surged from $35 an ounce to over $800. Never before in modern history has it been so clear. When paper money loses value, gold reigns supreme. But gold also experienced dark times. From the early 1980s to the late 1990s, gold prices slid, trapping those who bought at the peak. The financial world called gold a dead metal. Wall Street turned its back. Investors poured money into stocks, bonds, and technology. Gold was considered old-fashioned, a remnant of the past. But it was precisely during that forgotten period that patient investors accumulating gold prepared for a comeback wave as the world entered a new cycle of instability. Reality shows that gold's supply cannot suddenly increase sharply. There are no major new discoveries, no giant mines emerging. Each new gold mine is increasingly difficult and costly to exploit. Meanwhile, demand continues to rise steadily, from India, a nation enchanted by gold jewelry, to central banks, from investors to industry. This imbalance is the fundamental reason why gold never disappears from the game. If you look at gold only by its price, you'll miss the most important thing. Gold is psychology. It's the fear of crisis, the greed of seeking refuge, humanity's collective memory of a value that never collapses. Stocks can go bankrupt, bonds can default, paper money can lose value overnight, but a bar of gold in your hand is still gold. And that's why I never underestimate gold. It carries both a mythical aura and is backed by solid fundamentals: scarce supply, persistent demand, enduring value. Gold doesn't always shine, but it's always there, waiting for financial storms to make people seek it as the last harbor. Part 8. A heavy metal with strong potential for ascent. There's a peculiar paradox in the world of commodities. Seemingly mundane, overlooked things can unexpectedly become stars. Gold has its mystique, oil its power. But what about other heavy metals? There's an important lesson there. Sometimes, it's the less glamorous raw materials that hold the key to the modern economy. Look at the supply picture. Many believe metals are always abundant. Just dig deeper, open more mines, and you'll find them. But reality is far from simple. Many mines are depleted or rapidly declining. Opening a new mine not only requires colossal capital, but also faces legal, environmental, and political hurdles. Ore quality is continuously decreasing, meaning to extract a ton of metal, more rock must be processed, consuming more energy. All of this prevents supply from keeping pace with demand. Meanwhile, demand is continuously escalating. Metals like copper, zinc, nickel, and lead play essential roles in modern industry. Think of batteries for phones, computers, electric vehicles, solder in construction, ammunition and the defense industry, and energy and transportation infrastructure. All consume heavy metals, and this is a type of persistent demand. You might postpone buying a new TV, but you cannot build a city without steel or zinc. The story of prices also speaks volumes. The historical prices of these metals have always been wildly volatile. Sometimes abandoned, prices bottom out. Sometimes in short supply, prices surge in just a few months. But the long-term trend is always clear. When demand rises and supply is constrained, prices must go up. This is especially true in the context of emerging economies, led by China and India, which are devouring millions of tons of metals each year to build cities, roads, and factories. There's a classic case to draw a lesson from, the irony of lead and a commodity lesson. Lead was once widely used in gasoline, paint, and countless everyday products. But when its toxicity was recognized, it was phased out, considered a metal to avoid. Many thought lead would disappear from the economy, but what happened? It remained essential in batteries, in industrial applications, and in many uses that couldn't be immediately replaced. And demand maintained its value, so prices could still surge when supply became scarce. The lesson here is that commodities never completely disappear. When one application ends, another emerges. Demand can change form but rarely vanishes, and if supply is constrained, any residual demand can be powerful enough to drive prices higher. So don't just fixate on glamorous names like gold or oil. The world of commodities is much larger, and within it, silent heavy metals have the potential to become unexpected stars. For me, that silence is precisely what's attractive. When the world isn't paying attention, real value is often accumulating, waiting for its explosive moment. Let's look back at the case of lead to see the lesson clearly. For decades, lead was ubiquitous. It was in gasoline, water pipes, house paint, even some daily consumer products. Then, when science proved its toxicity, lead was gradually removed from daily life. Laws banned lead in gasoline and paint. Public health campaigns called for boycotts. People believed lead's era was over, but that was only half the story. Because at the same time, industrial demand for lead remained strong. The automotive battery industry, electrical utilities, and defense industries still needed lead. And when supplies were limited by these very new regulations, its value began to make unexpected jumps. The paradox lies in being considered toxic, boycotted, yet this metal still found its place in the modern economy. The irony of lead and a commodity lesson lies right here. Commodities don't disappear, they merely change roles. This case reminds us that in the world of commodities, what seemed dead can sometimes come back to life in unexpected ways. And the more important lesson, never underestimate any raw material based solely on its public image. The market operates on supply and demand, not on likes or dislikes or sentiment. In fact, many other heavy metals are following a similar path. Some were once considered old-fashioned, but are now becoming critical components for new technologies. For example, metals used in battery production, clean energy technology, and defense. As the world shifts towards electric vehicles and renewable energy, the demand for nickel, zinc, and related materials surges. New demand emerges just as old demand disappears. That is the fundamental rule. Commodities never die. They may lose their place in one sector but will return in another. And if supply remains constrained, every time demand returns, prices will explode. Looking further, this is also a warning to investors. Pay attention to the less noticed raw materials. When the whole world is busy looking at gold, oil, or prominent names, perhaps a silent heavy metal somewhere is preparing for its takeoff. And if you are the one who recognizes the opportunity first, it will be yours. To me, the world of commodities is like a stage. Each commodity is a character. Sometimes they step into the spotlight, hailed, prices soaring. Sometimes they retreat into the shadows, forgotten, prices plummeting. But no one disappears entirely. And sometimes, those seemingly supporting characters unexpectedly become the main characters, dominating the entire play. That's why I believe even overlooked heavy metals have the potential to become scarce commodities. And this is not a vague prediction, but based on the laws of scarce supply, persistent demand, and the continuous changes of the global economy. Part 9. Hunting for the next sugar shock. If there's one commodity that best reflects the market's volatility, cyclical nature, and even its addiction, it's sugar. This seemingly ordinary sweet condiment has created insane price surges, making some rich overnight while plunging many into ruin. For me, watching the sugar market is like riding a roller coaster. Thrilling, exciting, but also full of danger. The first thing to understand is that the global market is changing. Previously, sugar was mainly produced and consumed domestically, but today it has become a global market where a few giant nations play a dominant role. Brazil is the #1 sugar superpower, producing colossal volumes from sugarcane. India and Thailand are also big players. Their output not only serves domestic needs, but also exports, making global sugar prices directly dependent on the weather, harvests, and policies of these countries. The history of sugar prices shows a dramatic picture, its past ups and downs and the reasons behind them. In the 1970s, sugar prices rose by as much as 45 times in just a few years, then collapsed just as spectacularly. The reasons: an imbalance between supply and demand, droughts in one place, bumper harvests in another, changing export policies, coupled with a wave of rampant speculation. Sugar is a highly volatile commodity because it depends so heavily on harvests. Just a few % more or less rain than expected can cause prices to fluctuate wildly. The supply factor for sugar is therefore extremely erratic. A year of drought in Brazil can send prices soaring. A bumper crop in India can cause prices to collapse. Governments also intervene strongly. India often subsidizes sugarcane farmers, while Brazil can shift policy between using sugarcane for sugar or for ethanol production. Therefore, global sugar supply is like a pendulum, swinging one way then the other, never stable. On the other hand, demand for sugar has a special dimension. It comes not only from human consumption of sweet candies, beverages, processed foods, but also from energy. Brazil has built an entire ethanol industry from sugarcane. More than half of the cars in that country run on gasohol, a fuel blend containing ethanol from sugar. This ties sugar and oil prices together. When oil is expensive, ethanol becomes an attractive alternative, leading to strong growth in sugar demand. When oil is cheap, ethanol loses competitiveness and sugar demand falls. This linkage makes sugar a unique commodity, both an agricultural product and an energy source. It's sweet in your morning coffee, but also the fuel propelling a car down the highway. Few commodities embody such a duality, and it is this duality that keeps sugar prices in a constant state of uncertainty, full of surprises. The remarkable thing is that despite its erratic fluctuations, sugar never disappears. Humanity's craving for sweetness seems to be instinctive, and energy demand only increases. Supply can be erratic, prices can dance, but in the long term, demand remains, and whenever supply falls short, prices will explode, creating a sweet, intoxicating, but dangerous euphoria for those who aren't alert. One of the things that makes the sugar market special is its sensitivity to small fluctuations. Just a few % change in global production can cause prices to fluctuate violently because sugar reserves are usually not large, and demand is almost fixed. People don't stop drinking tea, coffee, or eating sweets just because sugar prices rise. Therefore, any shock from the supply side is immediately reflected in the price boards. I've witnessed sugar prices skyrocket just because a hurricane devastated sugarcane fields in the Caribbean. Within a few weeks, futures contracts on the New York Exchange almost doubled. Conversely, there were times when sugar prices plunged simply due to a bumper crop in Brazil or India. This extreme volatility makes sugar a favorite playground for speculators. They are captivated by the speed and amplitude of fluctuations, like gamblers drawn to a roulette wheel. However, behind this volatility are still fundamental laws. Supply depends on nature and politics. An erratic rainy season, a subsidy decision, an export policy all can change global supply. Demand, meanwhile, is more stable but linked to energy. And this is the crucial point. When oil prices escalate, ethanol from sugarcane becomes an attractive alternative. Brazil, the largest producer and exporter of sugar, can immediately shift sugarcane from sugar production to fuel production. This action tightens sugar supply, pushing prices higher. Conversely, when oil is cheap, ethanol isn't competitive, sugarcane reverts to sugar, supply becomes abundant, and prices fall freely. This linkage transforms sugar into one of the rare hybrid commodities, reflecting both consumer habits and the energy market. History has repeatedly shown that sugar can bring a price frenzy to those who participate. But the important thing is to understand that, like all other commodities, it still operates according to the law of supply and demand. Speculation can amplify, but the root cause remains that humans need sweetness and the world needs energy. The lesson for investors is very clear. Be wary of sweet euphoria. It can take you to the top in just a few days, but can also crash you into the abyss in an instant. And only those who understand the fundamentals, closely monitoring harvests, policies, and oil prices, can survive in this game. In my eyes, sugar is proof of a truth. Even something as seemingly simple as those white crystal grains has the power to stir the global economy. And for investors, it is there in the smallest, most familiar things that the greatest opportunities are hidden. Part 10. Can coffee bloom? No beverage is as intertwined with modern life's rhythm as coffee. From the small roadside cafes of Istanbul, where mocha and java began their journey, to the ubiquitous Starbucks lining every New York street, coffee has traveled a long way around the world. Each coffee bean, originating from Ethiopia, spread across the Middle East to Europe, crossed oceans to Indonesia, Brazil, Colombia, and ultimately became an indispensable drink in American industrial life. Today, no one considers coffee merely a beverage. It's culture, the heartbeat of urban life, something associated with keyboards, offices, night shifts, and morning routines. Yet, behind that cup of coffee lies a fiercely volatile market. Supply depends on the natural cycle of coffee plants. When prices fall low for years, farmers are forced to neglect care, cut back on fertilizer, and even uproot trees. The consequence is reduced production, a contraction of supply. When prices rebound, they plant new trees, but it takes several years for the trees to bear fruit, meaning coffee supply always follows a slow cycle and cannot immediately ramp up. Additionally, the distinction between Arabica, the bean favored in America and Europe for its refined flavor, and Robusta, a bolder, more bitter variety often used in instant coffee, further complicates the market. A fluctuation in Robusta might not offset a shortage in Arabica, and vice versa. The biggest risks remain weather and disease. A severe frost in Brazil can destroy millions of coffee trees, setting back production for years. Extended rain in Colombia can cause fruit rot. Diseases like leaf rust or pests have devastated many regions. Unlike metals or oil, you cannot store coffee underground to extract when needed. A failed harvest immediately means prices jump. Conversely, demand is stable and steadily expanding. In traditional markets like the US, Europe, and Japan, coffee demand has become a hard-to-change daily habit. Every morning, hundreds of millions of people cannot function without a cup of coffee. Meanwhile, in emerging economies, demand is expanding thanks to coffee shop chains, the spread of urban culture, and a rising middle class. From Mumbai to Hong Kong, from Shanghai to Seoul, modern coffee shops sell not just beverages but a lifestyle. And the most interesting question, what about China? This nation, historically associated with tea culture, is changing. 1.3 billion people, hundreds of millions of whom are entering the middle class, could ignite an explosion in coffee demand. But this process isn't simple. Tea has been deeply ingrained for millennia. The expansion of coffee happens in waves, starting with urban youth, then gradually spreading. China could become the world's largest customer, but that journey will be bumpy, interspersed with slow and fast growth phases. Nevertheless, the outlook remains clear. Coffee's prospects are tied to constrained supply due to lack of investment, increasingly extreme weather, and continuously rising demand, especially from Asia. Coffee prices, therefore, have room to recover and go further. But it's also important to remember that volatility will always be a characteristic. Those who participate in the coffee market must accept that prices might surge this morning, but a good harvest in Brazil could send them plummeting just as quickly. Coffee is a microcosm of the commodity world. Familiar, unassuming, yet holding global power. And like your morning coffee, this market can both wake you up and make you tremble if you lack courage. There's an interesting aspect to the coffee market. While demand steadily rises, supply fluctuates wildly, causing prices to swing more strongly and frequently than many other agricultural commodities. Just look at the coffee price cycles over the past few decades, and you'll see those peaks and troughs repeating in rhythm with supply and weather. Every time a frost sweeps through Brazil, prices jump. Every time production recovers, prices plunge. Speculators consider this one of the most dramatic playgrounds. But behind the short-term fluctuations, the long-term trend is gradually becoming clear. Supply is not easily expanded. A coffee plant needs several years from planting to harvest. Once farmers have cut down trees due to low prices, it takes many years to restore production. Additionally, climate change is making harvests even more unpredictable. Drought in Brazil's far east, unusual rain in Colombia, diseases spreading faster in hot, humid conditions. All this makes supply increasingly fragile. Meanwhile, demand is expanding in an almost irreversible direction. Asia's growing middle class is driving the popularity of coffee shops. You can walk through Shanghai and see numerous modern coffee chains where young people work on laptops, chat, and meet. In India, traditionally accustomed to tea, urban youth are also starting to drink cappuccinos and lattes. Coffee is not just a beverage, it's a symbol of urban life and globalization. The question of "what about China?" is increasingly weighty. China has gradually become a major importer, and its potential is enormous. Even if only a small fraction of its population switches from tea to coffee, the impact on the global market would be significant. The explosion in the number of coffee shops in major cities is a clear signal, but at the same time, this process is not linear. It sometimes accelerates, sometimes slows down, reflecting the clash between tea traditions and the wave of globalization. The outlook for coffee is therefore two-sided. The long-term prospect is positive, but short-term volatility will always be fierce. Investing in coffee means accepting instability, but it also means immense opportunity. If supply continues to be choked by underinvestment and climate risks, while demand expands, coffee prices will have plenty of room to go further. Coffee teaches us one thing. Even a seemingly simple beverage reflects the profound conflicts of the global economy, the imbalance between supply and demand, the impact of nature, the power of culture and consumer habits. And for investors, it's a reminder that what you hold in your hand every morning is not just a cup of coffee, but the result of a global supply chain where millions of farmers, factories, traders, and hedge funds all participate in a complex game.